Officer training series with the mortgage calculator. Tonight we're going to go through the Fannie Mae versus Freddie Mac differences. We'll get started with that in just a moment here. We'll wait just a minute to get started while we go live on all the different platforms because we are streaming this live on YouTube, Facebook, and LinkedIn. So we put the chat up on the screen in the meantime for you to drop comments as you tune in. And I see some people were already dropping comments there. Appreciate that. We'll get started here in just a moment. All right. It looks like we are live on all the different platforms, so we can go ahead and get started. Appreciate those comments. Keep dropping comments there as you tune in, and feel free to ask any questions there in the chat as well that Jose can answer for you. Welcome, everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. This is our loan officer training series where every Tuesday and Wednesday night at 7 p.m. Eastern, we go through a new training topic for loan officers. Now, today's topic is going to be the differences between Fannie Mae and Freddie Mac. So taking it to the basics here with conventional loans. So our sales manager, Jose Gonzalez, with 28 years of experience as both a loan officer and a realtor, is going to break it down for us here today. So you can go ahead and take it away here, Jose.
All right, Fannie Mae versus Freddie Mac almost sounds like a boxing match. Let's put on our gloves, right? So, what exactly are we talking about, right? So, let's break this down a little bit before we get into it. Agency loans, right? Agency loans are you have government sponsored enterprises that handle a segment of agency loans. Basically, the conventional segment of agency loans are handled by government sponsored enterprises, which are GSEs, also known as GSEs, which are a quasi, because there can be anything. In this case, we're talking about Freddie Mac and Fannie Mae, two GSEs that are out there. Quasi, notice quasi is the important word, governmental entities established to enhance the flow of credit to specific sectors of the U.S. economy. Agency loans are issued or guaranteed by government agencies, right? So in this case, we're talking Fannie Mae, Freddie Mac, FHA, VA, and USDA. As you know, when you go to my loan officer training, we talk about the agency segment before we talk about our amazing non-QM offerings, right? So Freddie Mac and Fannie Mae are the two GSEs established to provide liquidity, stability, and affordability to the conventional agency loan market by providing liquidity, basically ready access to funds on reasonable terms to banks, S&Ls, and mortgage lenders. There we're breaking it down in real theory here by purchasing their loans. They basically create the secondary market for conventional agency loans. That's really important to note, especially on a day like today when you have secondary market changes. So they are, as I was mentioning, the secondary market for the purchase of conventional agency loans. Each has their own specific set of guidelines and obviously an algorithm in their AUS, resulting in different outcomes. Just this week I've had multiple meetings with MLOs to disclose files on agency loans, conventional agency loans, where they were able to obtain the automated underwriting approval on one system, but not on the other. And LP, which is the Freddie Mac system, seems to be the more lenient one, as we'll get into in a minute. Now, conventional agency loans, as we all know, tend, not always, but tend to have lower interest rates than other types of mortgages. However, if you've been attending our daily rates show in the morning lately, We've had cases where the DSCR loans are beating out the agency investment loans. So not always exact. So, who exactly is Fannie Mae? Again, Fannie Mae, which is a Federal National Mortgage Association, creates secondary market by purchasing residential mortgage loans according to a specific set of guidelines. Their Fannie Mae guidelines, which you can find in their Fannie Mae selling guide. That's where they break it down. They even have the Ask Polly feature that you can go in there, type your keyword in the search bar, and they'll give you a bunch of options. They also have the Fannie Mae website for the consumers to go to. Their AUS is DO or DU, depending if you're a lender or a broker. They have as low as 3% down options through the Home Ready program. The conforming loan limits, when you hear about conforming loan limits, it's going to be a conforming loan, conforming to either Fannie Mae guidelines or Freddie Mac guidelines, but the word conforming is the one that came out of that. In this case, 726,200, but it does vary by zip code and census tract. So you got some areas like in California, LA, for example, which is over $900,000, I think $1 million, something like that, for a high balance conforming loan. Freddie, again, secondary creates a secondary market by purchasing residential mortgage, again, according to a specific set of guidelines. The Freddie Mac guide that you can find right there, guide.freddiemac.com, not as user friendly as the Fannie Mae selling guide, which has the Ask Polly feature kind of deal, but still you can find what you're looking for. It was created in 1970 to expand the secondary market for conventional agency loans, basically increasing competition and increasing, likewise, liquidity. One thing to note now, both of these GSEs are under the conservatorship of the FHFA. So, it's like they're operating under the auspices of the same governmental agencies. That's why you see a lot of these loan amounts similar, but their guidelines still are very dissimilar. Freddie Mac has 3% down through the Home Possible program, and Fannie has their 3% down. Freddie has AUS's LP, Loan Prospector, right? So they have Home Possible, and Fannie has Home Ready. Same. Now, what are some of the key differences between the two? This is what we got to really analyze. And I love that slide there. That's basically 2008. Throw that as a little comic relief, trying to wake you all up out there in case I'm putting you to sleep. But Freddie Mac generally has more flexible credit score requirements and a more flexible credit algorithm. I see it all the time on the files when you get the automated approval on LP and you don't get it on DU. Freddie Mac is more flexible with non-occupant co-borrowers. Fannie is more restricted with non-occupant co-borrowers. Freddie's renovation program definitely more flexible, including with ADUs and manufactured homes. If you all noticed, recently we had our manufactured home training. Freddie's renovation program allows a manufactured home to have an ADU, but it has to be stick built. Can't be a manufactured home having like a little baby manufactured home behind it as an ADU. They're not going to take that. It has to be site built ADU. But in general, right? Freddie is more lenient with RSU, restricted stock units, to be used as qualifying income. Much less restrictive in that. I mean, that's a real niche area, but there's a lot going on for those that have that. And here's one really, really interesting one to note, right? Regarding gift donors, right? Real important here. With Fannie, the gift donor guidelines, basically you got to be blood relative or married, right? Grandma, uh, mother, sister, brother, kind of wife, in-laws, because they're your spouse's parents, right? They'll allow stuff like that in Fannie. Freddie will allow unrelated individual with family-like ties to the borrower. Now, what does that mean? That's a mouthful. That means it's a very close friend, somebody who's there at the Christmas dinners, Thanksgiving dinners, somebody who you may take vacations with, a really close friend that you can document by some letters of explanations and stuff like that from the donor. So keep that in mind. If you have a donor that's unrelated with by blood, according to Fannie, but they're a family-like friend, very close friend, you can do it Freddie. Right? So that's real important. I've actually done one like that. Freddie allows interested party gift funds. Fannie doesn't. Freddie allows interested party gift funds subject to interested party contribution limits based on the LTV usually. So typically it could be 3%. But note that Fannie doesn't allow that. Freddie does. So those are some pretty good points there to know, highlights. Now we got a few more here. Um, Freddie, like I mentioned regarding the renovation loan, but just in general, Freddie Mac is much more flexible with ADUs and allowing the use of rental income from the ADU. Fannie's not. So you got to really look at it. Now, this is again, we're talking agency conventional here. We're not talking now QM. But just note if you do have your full doc borrower with an ADU, not closing in an entity, not closing in an LLC, look to Freddie Mac, right? Because we have a lot of our homeowners with ADUs nowadays. The appraisal waiver algorithm tends to be much looser, and less restrictive in Freddie Mac than it does in Fannie Mae. You tend to get more the appraisal waiver. They have a different name for it in LP. They don't call it appraisal waiver. Can't recall the name right now, but it is your appraisal waiver, basically what we're talking about. That's why it's good if you think you should get it. Like if you have that low risk loan, low LTV, high credit score, try to run it on both and see if you get that appraisal waiver, because those appraisals can be pretty difficult. So if you can get an appraisal waiver, by all means, simplify your life. And here's another niche, but real important. Fannie has more flexible guidelines for closing in a trust. With Fannie, you only have to give part of the trust, and the title does not have to be in the name of the trust. With Freddie, you have to give them the whole agreement, and you have to close in the name of the trust. So it's like, wow, talk about being opposite ends of the spectrum in a category. And we recently had a trust loan, and it was non-QM though, DSCR, but it was quite a mission because of the trust. Freddie is also much more lenient with disputed accounts. In Freddie, if you get the accept which is what they call it in Freddie. If you get the accept, automatically you can forget about the disputed accounts. In Fannie, even if you get the approved eligible, you have to read the credit section of the findings to see what the findings tell you regarding the disputed accounts. It's either going to tell you, hey, we took them into consideration, you're good to go, don't worry about it, or it's going to tell you, hey, we weren't able to verify the information on the account. So even though you got an approved eligible, you have to downgrade your loan to manual underwrite, which there isn't any manual underwriting conventional, and or you have basically, in this case, you have to get rid of the disputed accounts by undisputing them and rerunning, and that could raise all kinds of havoc to the borrower's credit score, taking an account out of dispute status. So you got disputed accounts on a agency conventional loan. Loan prospector would be the best option. Obviously, run both, but these are, notice we're highlighting certain pinch points in transactions that can easily be missed, and disputed accounts in your credit report is one until you're on DU, and then it points them out to you, right? And the last 2 points, I didn't put them last. I guess this is what you would say last but not least, because I think these are probably disputed accounts. These last 3 points are probably the most important ones. The disputed accounts difference, and then these last two are just huge. Freddie calculates the deferred student debt payment. Pretty much all student loans right now are in a deferred status. If not, you're always going to have some amount of deferred student loans out there. Well, Freddie calculates the payment on the deferred student loans because, yes, folks, you have to put a payment in the application for those student loans. Just because it says zero doesn't mean you're happy, and it says zero if the borrower has a $225,000 in student debt because they went up to the Northeast somewhere and incurred a whole bunch of debt, and now they're trying to get that loan. Well, Freddie is 0.5% of the balance as your monthly payment, and Fannie is 1%. That's 100% difference. So on Fannie, your payment's $2,250. Freddie, your payment's $1,125. It's like, wow. So if you're structuring your loan, that's a big difference. Especially unless your borrower makes $1 million a year and is buying a $200,000 house, then nothing's gonna make a difference there. But that's usually not the case. They're usually going to get the best they can get. So structure accordingly. And the last one, last but definitely not least, this is one of the ones I love bringing up in my loan officer training when we're going over the lender guide, is self-employed borrowers. Freddie is super, super favorable, the option to go to for your full doc self-employed borrowers closing in a personal name for a conforming loan that doesn't have any issues that will not allow it to close an agency, right? Then you're looking at Freddie Mac for sure. And why? Well, I'm going to give you the clinical reason, and then I'm going to break it down for you a little bit so you understand. Um, it is more favorable for the self-employed borrower because Freddie allows the use of ordinary income versus distributions when the distributions are lower than the ordinary income on the Schedule K1. Now that's quite a lot coming at you, right? So let me break it down a little bit for you. Typically, your self-employed borrowers. Now we're talking about an S corp borrower or a borrower that receives a K1, right? In the K1, there's going to be two sections. One section is going to be the ordinary income claimed, and the other section is going to be the distributions that they actually took out of the business, right? Fannie Mae says, and usually distribution is box 1, 2. I mean, income is box 1, 2, or 3, depending what type of income, and distributions is box 16D as in distributions, right? So Fannie says that if in our scenario here, $100,000 in ordinary income claimed, $20,000 in distributions, right? You'd think, all right, 100 grand, that's the income. Not necessarily. If you're going Fannie says your income is 20,000 because the distributions were 20,000. If Fannie goes with the lower of the distributions or the ordinary income claimed on the Schedule K1. But Freddie says, well, we'll let you use the higher amount, the income that you claimed at 100,000, if you can show that your business has liquidity. So Freddie does have a liquidity calculator, just like they have their income calculator, which I think is a Form 91 versus the Fannie Form 1084. Freddie has their liquidity calculator. You pop in assets minus liabilities. As long as you have a positive number, the business has liquidity, and you can use the ordinary income versus the distributions, and you're gonna have $100,000 income for your calculation versus 20,000, and you'll have a happy closing. You don't want to get to underwriting, not remember this point, and then have the underwriter counter you with your income substantially lower, and now you're having to switch to Freddie and all that kind of stuff, and just avoid the headache and do your due diligence. But definitely, that is my one favorite point on the differences. That's why I save the best for last.
I don't see any questions there. You know what? I have a question,
Sure.
Jose. So, why does it feel like everybody's so focused on Fannie? Everybody wants to run DU. You never really hear people
Mm,
talking about running LP and
Man,
stuff. Why is that?
marketing. Well, Fannie's been around longer. Freddie's like the little brother that was brought on to keep Fannie in check. It was brought on in 1970, with the purpose of basically increasing competition, right? But Fannie has been around and already established. It's sort of like, why do people ask for a Band-Aid when they really want an adhesive bandage, right? It's just like the name that has been synonymous with conventional loans for so long. And even though I think DU came in at a later date, DU wasn't around when in 1970 when Fannie was formed. They were still manually underwriting all their stuff back then, but it's just marketing, name recognition, I guess. That's really what it boils down to. But really, you're leaving money on the table if you're not looking at these differences and trying to structure your deal with all of the available resources that you have. You have two conduits for conventional loans, Fannie Mae and Freddie Mac, and they have a lot of differences, and we should make sure that we are doing a good analysis. And we're giving you main points here, pinch points that can come and bite you. You know, if you stick to just these right here, you're gonna really capitalize on more opportunities.
Absolutely. All right. Well, I don't see any questions there, so I think we can wrap it up. Remember, everyone, we do this every Tuesday and Wednesday evening at 7 p.m. Eastern. So we have some new topics for next week that we're going to go through. Thank you, everybody, for tuning in. Thank you, Nick. Thank you, Jose. And we will see you our next Tuesday at 7 p.m. Eastern for the next episode of the Loan Officer Training Series with the Mortgage Calculator. Have a great night, everyone.
Thanks,
Thank you,
everybody.
everybody.